Good day, everyone. Thank you for joining us today. My name is Anne Deke. I'll take you through Adcock Ingram's investment right there. So we'll start off this presentation by looking at our executive summary. So we have a buy recommendation on the counter. And this is on the back of us seeing the company as a high quality stock. This is supported by solid cash conversion, high asset turnover, high dividend payout, as well as strong returns. We see the company's moat as mainly its combination drugs as well as pseudogenerics, which then afford the company higher pricing points relative to its closest competitor, which is Aspen. While we rate this stock highly, we still want to look at a few risks. So we are aware that the company operates in a highly regulated industry, and as part of that, the revenue growth is highly dependent on single exit price, which are determined by the government. Secondly, we've seen an influx of generics in the market, which has had downward pressure on original brands. But overall, as I've said, we are confident on the stock, and this is also supported by our valuation on the counter. We've used two valuation metrics, that is your EBITDA, as well as a PE valuation methodology, which then gives us a weighted intrinsic value of 61 rands 90 cents. When we compare this to the current share price of 49 rands 50 cents, we then arrive at a potential upside of 25%. Now, moving on to the recent results that the company released. So last year, the company released its full year results for FY 2021. I think the key takeaways were an increase in revenue of around 6%. This was on the back of recovery in prescription as well as hospitals, while OTC continued to struggle. This is because of lower sales and the flu as well as colds indicators, given that people were now wearing masks, so we didn't see heightened flu season. Operating expenses for the period decreased by 6% on a like-for-like basis. So here it's clear that the company has been able to manage its costs, but we think that what has enabled this is the split that the company has in terms of your variable costs as well as your fixed costs, with costs more skewed towards variable costs. HEPS for the period were down 3%. This is after taking into account the group's share repurchases that happened last year. Finally, the company also declared a final dividend of 90 cents per share during the period, which then gives us now a forward yield of 4.4%. That's a forward dividend yield. And this is ahead of sector peers. In terms of how the market reacted following the release of the results, so they actually had a muted reaction. So the share price closed 0.1% down, with the Cap Swiss down 0.2% on the day. But if you look at how it's performed over a 5-year period, it's clear that the company has underperformed the benchmark. So the stock has a limited coverage in terms of analysts, but when you look at our price momentum, it's positive, as you see on the chart on the right hand. It's positive. But then as PSG, we've done our own models on the stock, and we see recoveries happening in FY22. The main catalysts are going to be OTC as well as consumer divisions, as these divisions have higher margins. Now moving on to our valuations. We've used two valuation methodologies, as I've alluded to before. So starting off with the first one, so that would be the EV/EBITDA valuation. So for this one, we've actually done a scenario analysis, as you can see there on the table. So for our base case, for instance, we have a 9 times multiple. This multiple is below the 5-year average, and this is because we want to reflect the generics penetration and the downward pressure that it's had on original drugs price points. But for our bear case scenario, we've also tried to incorporate the impact of more pronounced COVID strain. So right now that would be Omicron. So if that plays out, or if we see an adverse impact like we saw with the Delta strain, then the multiple that would then apply to that scenario would be 7.9 times. So we then do a weighting for these scenarios. For instance, for our bear case scenario, we have a weighting of 20%. This is because we're not seeing this playing out as much as our base case scenario, even bull case. So we then arrive at a fair value of 63 rands. If we look at our PE valuation, we've also used a similar methodology. We then arrive at a 59 rands 40 cents. So when we weight these two valuations, we then arrive at a weighted intrinsic value of 61 rands 90 cents, which then yields an upside potential of 25.1%. The slide just shows the scenario analysis that was shown in the previous slide. I think the main key takeaway from this slide is that we can see right across all scenarios that the stock is attractive. For instance, for our bear case scenario, we have around 21% upside, potential upside on the stock. Lastly, just to bring together our buy recommendation view on the stock. So we've looked at a couple of factors which for us make us comfortable in terms of how the company is screening fundamentally. So for instance, we see that the company has a low business risk, and this is because when I look at our single exit price, it's expected to be around 6.3% this year, which gives us gives the company enough room in terms of their sales growth. In terms of value creation spread, here we look at ratio of your ROIC over WACC. We see that this ratio is still above 1 times, which means that the company is still adding value for its shareholders. Now, if you look at the execution risk, this is also low. There's 3 things that we look at here. So that would be the capital allocation, cost management, as well as pricing. Pricing I've already spoken to, so that is regulated through the SCP, and we're expecting it to be decent for the year, which is a positive. So now for capital allocation, the company has been very, very disciplined regarding the capital allocation. For instance, it's managed to grow mostly organically, with only very small acquisitions made. Which, if we compare this to an Aspen, you see clearly that the returns that you get for your Adcock, they are ahead of Aspen, and this is because Aspen has been growing fast. For instance, it adds a business every 2 years, which then slows its return on assets, for instance. And then in terms of cost management, the company has a split of 30/70 split between fixed and variable costs, and that has helped the company in terms of controlling its costs. And then in terms of financial risk, So here we look at the gearing of the company. So the company has a net debt to EBITDA of 0.2 times, which then for us means that their balance sheet is not an issue. It's actually very strong. So financial risk is low for those reasons. And then moving on to the last factor, that is the ESG risk. So I think the important one here would be the environmental hazard, and that's just the nature of the business. Given that this is a pharmaceutical company, it's something that we worry about. But and another risk that is unique to the company is the limited disclosure, especially in terms of the gross margins per division. We don't have those. We've had to rely on reverse engineering for us to get those numbers. So we've penalized the company in terms of the ESG risk. At this point, it's a medium risk. But overall, like I've said, we're expecting the company to still trade below your Aspen in terms of your EV/EBITDA multiple, and this is because Aspen has now signed the licensing agreement to distribute vaccine across Africa. But overall, the company is looking like a buy to us. Before we end off, we'd like to draw your attention to the following personnel. Should you wish to place a trade with us, please speak to your financial advisor or contact the dealing desk. Additionally, a report on Adcock can be found on my page. Before we end off, we'd also like you to take note of the following disclaimer. Thank you for your time.